Now, live from KUSI, this is Good Business San Diego. Sponsored by Wilsey Asset Management.
Hi, I'm Roy Robertson. Welcome to Good Business San Diego, where we talk about what's most important to you, your home, your health, your family, and your finances. And the following is brought to you by Wilsey Asset Management. This morning, Brent Wilsey's here to talk about some disturbing trends regarding how consumers are faring in this economy. Opening line from Brent's latest podcast sums it up. The consumer isn't breaking, but quietly running out of cushion.
Yes.
That's what I heard when I was listening to your podcast yesterday. So, yeah, we're a little cash strapped. No surprise, though, right?
Well, no surprise. I mean, we knew this was going to happen. We've talked about it, but the data we're seeing shows that, yes, consumer is running out of money, starting to have problems, and this is because of the war in Iran. We have higher energy prices. We have higher inflation, which is taking more money out of people's pockets, and therefore consumers having more difficulties. And this is important for investors because if people can't spend as much on products, well, that's less sales for the company, less profits for the company. Therefore, the value of their stock could decline. It's only temporary, so don't panic and sell everything. But just to understand, as an investor, this is what's going on. Be prepared. And we did see last week that the inflation numbers came out. The PCE, which is personal consumption expenditures, and the Fed likes that one best. It was 3.35% year over year, in line with the expected. However, that's the highest since November of 2023, so not going in the right direction, and a little bit concerned on inflation there.
Yeah, so we're worried about that, and inflation dictating all of the costs that we have to outlay on everything, and it's also impacting the ability to save money.
Yep, and that's a problem. The personal savings rate is also declining because that came out at 2.6%, and that is pretty low because last month in March it was, what was it, 3.2% last month, now down to 2.6. And even more important, year over year, last March, it was 5.8%. So therefore, it is declining. And this is important because consumers need to put away money for emergencies and their retirement savings. They need to do that, and they're just not doing it because they're being squeezed dramatically. And this is the worst since the pandemic, 2022. Was 2.2%. And if you want something for the average, the norm, well, 2010 to 2020, the savings rate was about 5 to 7%. So we're about half, better than half that right now, the savings rate. We need to get that changed.
And so it's what people are turning to that really becomes the problem, and primarily it's borrowing from a 401k.
Yeah, and I hate saying that, and I've said this before, do not touch your 401k. And this is why I like the old pension plans. The old pension plans, you could not touch those because they were by the company. So you had a problem, well, you couldn't touch your 401k, well, your pension plan. Right. Initially, the 401k was that same way. And then I think because of political reasons and congressmen wanted to be like voted back in, oh, let's loosen up the rules. Terrible idea because this money is for retirement. And I was talking to Scott earlier during the break that, you know, what are people going to do? They're going to have a terrible retirement. They might be, you know, 70 years old renting a room from somebody because they have nothing for retirement. And people just don't think about that. The other thing, we're a little bit older. We said, well, people don't realize when they're 30, how fast time goes by. How do you get to be 60, 70? So
I hear you, brother.
Right, exactly. And people in their 30s, oh, it doesn't matter. It's only, you know, 10,000. I'll only borrow it. And it does matter. And just because you borrow against it, think, oh, I'm paying myself back. Terrible idea because that won't do as well in the investments. And the numbers are 19.2%. Almost 1/5 of people have now borrowed against their 401k. And that's up from 18.8% last year. So increasing, getting worse.
No, double dip effect too. I mean, you're missing out on market return in addition to the fact that you're needing to repay yourself. So and no bright side to that.
Yeah, and then even worse than that is these hardship withdrawals. And I know people say, oh, Brent's so mean, not be able to take those. But again, it's your retirement. And the hardship withdrawals, I mean, they were up to what? They're now 6% of people taking a hardship withdrawal from 4.8%. And this is where you can take money out to buy your first home. Terrible idea. I'm sorry, terrible idea. You can take it out for tuition. Terrible idea. Maybe if your house can be foreclosed on, maybe that makes sense. But these are things, your 401k is not an emergency fund as Congress has made it to be. It is for your retirement. Don't touch it. Don't borrow against it. Let it grow for you.
Bottom line, as tough as it is, you got to show a little discipline. And leave that money for retirement when you're really going to need it.
When you're going to need it.
Don't compromise it.
And as you know, you get to be our age pretty quick.
Okay, that's enough. Appreciate that. You'll find Brent online at smartinvesting2000.com, and we'll be right back with more of Good Business San Diego right after this.